On the YouTube channel, I've talked numerous occasions about reverse mortgages and how I think the HELOC is not a good equivalent of a reverse mortgage, simply because if you're retired, you don't have that much income. It's going to be hard for a bank to qualify you for a home equity line of credit on residing on Social Security income alone. So reverse mortgage is a nice solution to that, but the drawback about reverse mortgages, as I stated many, many times, is that there is a pretty significant FHA fee that goes with that, plus the 0.5% that goes with it on an annual basis. So the closing costs can be pretty elaborate for sure. So I was watching Beat the Bush, Francis or Beat the Bush, and I've shared a couple of his videos with you guys before, and he got solicited on a mailer by Unison, and he talked about it, and he wasn't down on it. He didn't think it was for him, and I get that, but I had never heard the idea of how this works, and I said, there's more to this, and I think my man Francis at Beat the Bush is looking into it. And nothing wrong, I'm not faulting him or anything like that. I just said I think there's an opportunity here, especially when you factor in if you have equity, you don't want to move, you don't want to pay the 3%. We're talking thousands and thousands of dollars of closing costs reverse mortgage. But you do have some income limitations, and maybe you want to age in place. Lots of different things that can go on with your home that you can't exploit unless you do one of the two things: home equity line of credit or reverse mortgage. So Brody, it's my pleasure to have you on board from Unison. And if you don't mind, just tell us a little about who you are first, how you came on board with Unison, and we'll just go from there if that works okay.
Sure. I studied at Berkeley, and I actually did my master in financial engineering. Did my thesis before graduating on how to build a good portfolio with very illiquid assets. Really focused on real estate. That was the most interesting one to me. And one thing I noticed was, and people don't really talk about this as much as they should. I think people have way too much home in their portfolio. If you really, if you're strictly looking at this in a very, let's say, theoretical sense, but even practically, and I think we learned that lesson 10, 12 years ago. So I was extrapolating from the stock market, and we thought that there should be a way for homeowners to be able to sell equity in their home, not just borrow and be paying cumbersome monthly payments. I stumbled upon a company called Unison that was doing exactly this. So I now work for them. It's been just over 3 years, and we've grown substantially.
How did you stumble on use? I'm just curious. So you're doing your research. You see there's some opportunity here, but how did the two rows connect, so to speak?
So I actually was I was going to continue to continue post-grad education, but one of my coworkers at the time, one of my colleagues, Brad, he found the company. He told me about it. He knew I was really interested in this field, and he just wanted to talk about kind of the theory behind it, how this could actually work. And we spent, I think, 4 or 5 hours in the lab in the library, and I immediately contacted the company. I was immediately interested. I really thought this was inevitable, and I still do. Whether or not we're the ones who can, open up the equity market for real estate, this will exist in 5 or 10 years. And I think we have a great chance of, opening the door. I hope more competitors join the field as well.
So the issue about too much home in part of the portfolio, man, I could not agree with that more. In fact, I think there's like trillions of dollars of assets. I don't know off the top of my head, but I just remember reading this. Again, I'm not going to quote it accurately, but of equity, and yet there's also this issue that people don't have enough positive cash flow, and yet it's like these two things doesn't make sense to me. Do you know the numbers behind how much equity is out there in homes relative to
it's unbelievable. I mean, it's the biggest asset class in the world, and so there's about I think the number from last year is 25 trillion in the United States. It's probably gone up since then. I think about 10 or 12 trillion of that is debt financing. The rest of that is individual homes on individuals' portfolio. You highlighted the liquidity problem, which is huge. That this is an asset that you're going to have to service every month. It's going to be a substantial part of your income, up to 45% in areas like San Francisco, right? That's a lot lot of cash that you're burning up every month. There's a last problem that is a little more technical, but it's really substantial. You know how they say you should diversify your investments, like you should buy
Right.
not just Apple or Amazon, like you should buy the S&P 500. Well, with a home, you're not buying a diversified basket of homes. You're buying a single home. And a single home is a lot riskier. It's a lot riskier than people have been led on to believe. And even research articles that I'm reading today are still, quoting kind of the diversified risk number for homes. But it's um, it's a lot riskier than people think. And you have a lot of it on your portfolio if you're a homeowner. Not to
Yeah.
say that it's a great asset. You get to live in it. It's a,
Right.
a roof over your head. So it's I think this solution is necessary. There needs to be an equity market for this asset.
But it's imputed income from just not having to pay rent, which is great. It's freaking great. But if you're not having to pay rent and then you're on top of that, putting $2,000 a month into a mortgage, that's a tough nut to crack in terms of successful retirement planning. Especially if the median income in the United States is only $60,000, and so if you got a $1,500 or $2,000 a month mortgage, that's in retirement, and your median income is only again, that's the income, $60,000. So the median retirement income is much lower than that. And the irony of it all, and one of the reasons I want to talk to you, Brody, is that the number one expense for retirees by far, nothing comes close, is housing. And everyone focuses on healthcare, and it's not anywhere near what housing is. And so the issue is, if we can get your housing reduced to some capacity, or at least have some flow from it, it's going to just open up this retirement option that no one talks about. It frustrates me. How did so tell us a little bit about Unison, the company, how it became, I literally think in 10 years from now, everyone will know what this is going to happen in terms of what you guys are doing. But just tell us a little bit about the genesis and all that, if you don't mind. I'm incredibly interested in how this came to be.
Yeah, I think it was just this idea of opening up the equity market for real estate. So if you start a company, you have two options to finance your operations. You can borrow money and pay monthly payments. This would be like the mortgage for a homeowner,
Right.
Or you can sell stock. And this is something people in Silicon Valley are very familiar with. These startups that don't necessarily produce cash flow every month, they still have a way of financing their future success, and that's by selling stock. And the idea of selling stock is that you're going to give me money now, and you're going to take the risk with me on the success of this investment. And I'm not going to pay you monthly payments, because you want me to be able to continue to operate. You don't want to take away some of that cash that I could reinvest in the business. And that's a true partnership. The equity investment has a lot of side benefits, other than just not having that that monthly payment. You really feel like you have someone who's on your team. They want you to succeed. They win when you win. Whereas a debt financing or a mortgage, if you're not behaving the way that they want you to behave, if they think you're taking too many risks, they're going to come down on you, and in the worst case scenario, foreclose on your home, or force your company into bankruptcy. So that parallel is very important to, let's say, the genesis of this company. It started by Thomas Sponholtz, our CEO, started this company, I think maybe 13, 14 years ago now. And
okay.
And they, this is pre crisis. They had a lot of,
right.
People really had a lot of equity in their homes, and he was trying to get homeowners to take risk off the table, sell it into a diversified portfolio. And then once the crisis happened, it more than anyone kind of imagined, things slowed down. We really reinvented the company. Now it's called Unison, 2-3 years ago, and since then we've been really focusing on our two products, home buyer and homeowner. I think for this conversation, homeowner is the most relevant, and we've been having a lot of success. Almost 5,000 deals now, and over $400 million invested.
How does he get the funding to? Where does it come from? Where does he get the money? The $400 million. Where's that capital raised from?
So we operate as a fund manager. So we raise money and build funds for very
Okay.
long-term investors. We target sovereign wealth funds, endowment funds, pension funds. These types of really long-term investors
Yeah.
who they can't find yield in the market right now.
Exactly.
And
Yeah. Right. Right.
well, and you mentioned this, right? The most important expense is housing. And really, if you think about it, when we talk about inflation, which is what a pension fund should, as your life expenses increase over time, your pensions should be paying more and more. But if housing is the main component of that increase, wouldn't it be great to own an asset that goes up and down with housing costs? So it really helps them match this liability, for and this works for endowment funds and sovereign wealth funds too, who also have real estate's a big expense for them. Um, so these big funds, they want exposure to residential real estate, and they haven't been able to find it on the market. So what we're doing is building diversified portfolios of single family home equity, and that's we're finding a lot of demand for that on the investment side, and on the homeowner side, it allows them to take some money off the table and
Yeah.
create a little more liquidity and be able to diversify diversify away from just one asset.
No, man. Financial planning 101, diversification. Everyone,
Right.
we talk about modern portfolio theory, we talk about all this stuff, but the facts are, if you have $300,000 in IRA and $800,000 home, well, heaven forbid that home your neighborhood becomes populated by MSN 13 or whatever it's called. You know what I'm saying? I mean, then that home is not worth $800,000 anymore. And just personal experience of seeing previously bedroom communities of Washington, D.C., which are now notorious for being crime-infested gang communities. If that was someone's in 1970 was their retirement home, they were going to sell it to fund retirement. Those days they're not doing it. They basically can't give away those houses anymore, and yet they spent
Right.
thousands and hundreds of thousands of dollars in there, and thus diversification away from that residential real estate, in of itself. Doesn't mean it can't go the other way, but it just means there is risk. Like I think you said you attested to before, that a lot of people are unaware of. On the so now on these pension funds, and that these are long-term investors who have long-term time frames, so they're not calling like a home equity line of credit. Give an example: in 2008, a lot of banks were calling their HELOCs because they said, "Oh, if you see the fine print." It says if things go from to hell in a handbasket, we can call these home equity line of credits, and you are basically SOL if you borrowed 100% loan to value.
Yeah, that was bad. That was
horrible.
Good.
Yeah, hell, it happened to me. If it wasn't on home equity, it was on a credit card from Soup. Well, let's put it this way: 0% financing for life of the loan, Brody, until 2008 happened, and all of a sudden it's like 14.9. I said, wait a second, I wasn't late on this. What happened? It was just the nature of the beast. But with these pension funds, sovereign wealth funds, and whatnot, endowments, they are in there for the long term, right? They're not looking at this today and say, hey, Josh, I noticed you didn't mow your lawn or anything like that. They're there for the long term, right?
I mean, that was a really important lesson for everyone in the financial services industry. I mean, you have to be very clear and very transparent about what your product does. What are the features? If you want it to work longer than one business cycle. So that's something that we've really integrated in our process. We force our homeowners to take a very short, and we think it's kind of a fun little quiz to make sure they understand all the aspects of our agreement, because you need to know what you're getting involved with. This is one of the biggest decisions of your life, and if you're not going to feel good about a decision if you're not confident about it.
Right. Absolutely.
And just going back to your diversification point, yeah, I saw we watched Harry Markowitz come and give a talk here in San Francisco, and it was one thing he said. I think he said in one of his first papers on portfolio optimization. Harry Markowitz is one of the first great financial engineers of the 20th century, and he said, to this day, the diversification is still only the only free lunch in finance.
If you take advantage of it.
If you take advantage of it, yeah.
Right? Most people don't. All right, so let's talk mechanics. All right, so I mean, I've the folks who listen to my YouTube channel, I think they get a pretty good gauge about reverse mortgages. I think most people get home equity lines of credit. But let's just use, just a typical, soon to be retiree, 62 years old. They got $300,000 home, just for example. Maybe they have a $100,000 mortgage or not. We can go both ways. They want to age in place. Their grandkids are around, their kids are around. They just like their community in East Texas or whatever. It doesn't matter. Frankly, it doesn't matter. I have an avatar in my head of some folks I talk to in East Texas. This is almost part and parcel of their home. $300,000, $100,000 mortgage, 62 years old. Good, in this case, pretty good income. But how does it work now? And we can use both. They're 100% loan to 100% equity, or in this case, 65% equity. How does it work for a Unison to come on board and partner with them?
Sure. I'll take just very simple numbers. So in one example of a homeowner deal, well, for a $300,000 home, we'll give you 10% of the value of your home right away, and we'll wire that to your bank account. Then you have for up to 30 years, it's your home. You do whatever you want with it. You don't pay us a cent. When you sell your home, you will calculate what was the change in value, and we'll share in 40% of the change in value from that point. And that's our share of the gain. We'll also share in the downside. So if your home goes down in value, we'll protect you on the downside, which gives you that, that's the kind of the diversification benefit, is you can move, chips off of that home and put it somewhere in some other asset. If you make any modifications to the house, that's all those gains are taken out of the final computation. So those are yours. We want to encourage you to renovate your home and maintain it. That's a good idea for you, and it's a good idea for us. And you can also buy us out on an appraisal. So if you have the means now to let's say you want to end the agreement sometime before the 30 years, then you can get an appraisal and buy us out at that value.
So let's just go back to $300,000. Does it matter if you got a mortgage on it or not? I mean, I guess that has to matter to some degree because you can't be 100% loan to value, right? I mean, but in this case, a $100,000 mortgage, would y'all still provide 10% of the appraised value?
Right. If you had a $100,000 mortgage, absolutely, that's no problem. We typically want to, if you don't have, so if you have a reverse mortgage already on your home, that's the only case where we would have to kind of investigate to make sure that there would be enough equity for us at the end. But for a normal mortgage, that's no problem at all. We'll do it if you have up to 75% LTV on a homeowner.
Oh, okay. Wow, really? So I mean, okay, so even if you have a decent amount of loan on your home, up to 75% loan to value, you still be able to put a pretty significant, $30,000 in this case towards. Okay, good. All right, so let's say $300,000 is the home, all right, and you're borrowing because it is a loan. I mean, they're paying it back at some point. It will be paid back with some kind of. Or what? I mean, do you call it a loan, or what is it?
We don't like to call it a loan just because it doesn't. Okay. It's not. There are no monthly payments. There's no interest. It's really like an equity investment. In the home.
All right, gotcha. So, all right, so let's just say you invest $30,000 in my home, whatever. Right now it's appraised at $300,000 and it grows to $400,000. So I get $100,000 of appreciation since you all gave me that $30,000. So you would get, and then I sell my house for $400,000. I would pay you back the $30,000 as seed money, and then you would get $40,000 because 40% of the $100,000 appreciation from the day we close the business. Am I seeing that correctly?
That's exactly right.
Okay. So I would still keep $60,000 of that appreciated value. You see what I'm saying? So
correct.
It's not so. In terms of we're partnering together. I still have upside potential as well as you do too. So it's not like I'm giving you all the equity, the appreciation. You're getting a portion of it, but I'm still getting a portion of it as well. So you are literally partnering in. For every $100,000, I get 60, you get 40 on top of the 30,000 that you initially, invested in me, if that makes sense.
That's exactly right. We want our homeowners
Okay.
to get, typically the lion's share of the upside, and them to be able to live in their home. Enjoy the value of living in a home.
All right. So so is it what's the is it based on age, like a reverse mortgage or something like that? How much, like, how come 10%, not 5 or 25 or whatever? I mean, what's the terms for how much you can get out of there?
So the terms are set based on the kind of the demand from the fund side. So
Okay.
we have we try to build a marketplace, as efficient as possible for both our investors and our homeowners.
Okay.
And we think right now that this is a good, fair price for
Okay.
both sides, and both sides feel like they're winning.
All right. So if you had a $800,000 home, you could get $80,000.
That's right. We'll do up to
Okay.
So we'll do up to 17.5% for a homeowner of the
Okay.
value of your home. So you can get more,
Gotcha.
but that will increase the share in appreciation or depreciation.
Okay. Understood. No, right on. I mean, if you're taking more risk, you expect to get more upside. I mean, it just inherently makes sense. So, could you do
Right.
17.5% on a $300,000 home, or is it based on the appraised value? How much you can you would invest?
It's 17.5%. It's just a percentage of the value of the home. So that would
Okay.
work for both your $300,000 and your $800,000
Okay.
home.
What's the appreciation? So it's 60/40 on a 10%. What is it on a 17.5%?
So it goes up. It goes up linearly. So if the rule of thumb is, if you double the amount that we give you, we'll double in the share of appreciation.
Okay.
So in that case, I believe it's 70% if you do 17.5.
Okay. Gotcha. All right. So then from the homeowner, you say, okay, so Unison, let's just go back to the $30,000 one thing. Unison is going to invest in me $30,000. Theoretically, I could put that in the market, do whatever. But let's just say 7.2% a year is I'm going to invest that money, and I expect to get 7.2% a year. So I double my money in 10 years. So now my $30,000 is outside of the equity. It's now $60,000. And this has that I've built, and now Unison, if I were to sell my home 10 years from now and it appreciated by $100,000, I'd pay you guys 30,000 plus the 40,000. So I'd basically, at the end of the day, I'm just kind of thinking out loud, but at the end of the day, it says, okay, I have $60,000 of cash, which I've taken from your investment in me, and it's going to cost me $70,000 to pay you guys back. So essentially, in that case, it only costs you $10,000. You don't need to answer that. I got to think this out loud in my head.
No, I have to do the same thing. And it's worth noting that on the downside, if your home does go down in value, then we'll share in that downside, and that just comes out of the kind of the seed investment that we gave you. And that really is helpful for someone who feels like they have their homes maybe has been in a very hot market for a while, and they just want to lock in some of those gains, like you would with a stock in your portfolio, and further diversify, rebalance the portfolio.
If you're sitting there in Seattle or something like that, or was it Vancouver, Canada, where they limited the Chinese build? I can't remember what it was. There's some kind of market in Canada where they limited the Chinese nationals.
Yeah, that is Vancouver.
Yeah, that you'd say, okay, well, that would put a hurt on the price. How is the appraisal done? I mean, is it a contractual appraisal from Unison? Is it a bank? How's it done? Because that would be the one question I'd have, is like, yeah, they're going to lowball me on the appraisal. How's that happen?
Yeah, that's a great question, and a very common one, which and it makes sense. We use third-party appraisals, so we don't, they're not an interested party in the deal, and rarely someone is not happy with the appraisal value. They can order a second appraisal, and we do have a backup process for that, and the details are online. But we really want the both parties to feel like there was a fair appraisal. And again, we want this to be a positive transaction for both our investor and our homeowner. We want to create a very efficient market for this asset.
I mean, even if the appraisal comes in where I'm like, oh, Unison, you guys are lowball me. I mean, I don't have to sign the dotted line. I mean, that'd be the thing.
That's right.
Yeah, you're not. I mean, it's not an irrevocable contract here that you haven't signed it yet. Okay. So is there like I'm 48 and I actually went online. I'm in Georgia and I didn't get any pushback from Unison about you weren't licensed in Georgia or I'm too young, like reverse mortgage. Is there any kind of limits on states, age, or anything like that? Income and what would be some of an underwriting? How's the underwriting? That's probably the better question. How's that work?
So we don't operate yet in every single state. I believe we're up
Okay.
to 30 states. I'd have to check the map. We're trying to expand as much as possible because if you think about it on the investor side, they really want a
Right.
diversified basket across the nation. Now, we even want to expand internationally. So, and we're hoping to do that very soon. The the issue obviously is the United States is not the rules are not the same everywhere. So we have to.
Right.
Our legal team works very, very hard to kind of cooperate with each state and talk about
Yeah.
kind of what rules are idiosyncratic for that particular location and how do we introduce equity investment to real estate in that state. So I'd have to check again the map to see if I believe.
Don't worry about it.
I'm not sure if Georgia's on the map just yet, but we're fighting to get every state on our map very, very soon.
It's like life insurance; they're all regulated by the National Association of Insurance Commissioners. Each state's little fiefdom. So if you have life insurance, you got to get Wyoming to approve it, Colorado. Each state is different. Okay, gotcha.
And we're happy for there to be good regulation on this. These are such important decisions, but with regulation comes just a little bit, a little bit slower. So, we're working hard on that.
What's the total closing cost? I know you said it's not like a FHA loan or anything like that, but I mean it's got to be a fee to do this. And what appraisal fee? What kind of fees go in terms of? I mean, I guess you're not doing title searches or anything, are you? I mean, what's the fees to go in to actually get this done?
Yeah, I believe I'm not the authority on the latest on fees. We're trying to bring them down as much as possible. I think for the home buyer product, it's somewhere in the range of 2.5% of the investment amount, and then for the homeowner product, I think it's in the 3 point something range, and this is in the amount that we invest. So it's which brings it down a lot more than let's say a small percentage on a mortgage.
So for a $30,000 investment, you're looking at basically $1,000. I mean, I know you're not committing to that here, but just it's basically 3% on a $30,000 amount. That's roughly $900. We'll just go up to about $1,000. Okay, well, that's a hell of a lot different than on a reverse mortgage. I get reverse mortgage people say, yeah, but I get all that, but again, the whole point is it's a different opportunity. So, and you don't have, I mean, like I'm 48, so I can still do this. So I say, look, I want to put a pool in my backyard. Let's just say for simplicity, I got 20,000 set aside for cash, and I need $30,000 or 40,000, whatever it is. I can go from 10 to 17.5. I don't have to be a Social Security age to get this, right?
Right, and that's I think a good point to highlight. If you do any improvements on your home, we will, in the appraisal, assess the value of those improvements, and that goes to you. So we don't share in any appreciation that you get because of some renovation that you did in the home. Again, we just really want to incentivize people to take ownership of their home and improve it. We don't want people to feel as though they're giving up all that work that they've put into making this their dream home.
Oh, right on, man. Now you said you do it on purchases too. I mean, I'm just curious. How's it, like someone's downsizing, and let's say they don't want to put all the equity they have into their their new home. How does it work with a mortgage? Well, not a mortgage, but a purchase home.
Yeah, so we have a home buyer product where we actually can get a little more competitive on the share and appreciation. So we'll do that for 35% and pretty soon 33% of the share of appreciation or depreciation for a 10% investment.
Okay.
So and hopefully soon be able to provide even more than 10%. And so just like you would imagine, you get an 80% LTV loan on the house, and we'll give you half of the down payment and share in that 33% of the share. So the reason we can do it, the reason it's more competitive on that side is because with the home buyer products, we have that kind of that market price where that you're purchasing the house at, that true sale, rather than that risk of the appraisal. There's always a little bit of uncertainty around that appraisal, and so that's the reason, if you're wondering why we can offer slightly more competitive share there.
That's interesting though. But you're saying, I got for simplicity, $100,000 house, obviously need $20,000 down to get a conventional mortgage. Unison can provide me 10%. I'm just using that for simplicity. 10,000 of that 20,000. So all I need to come up with would be the other 20,000 to avoid PMI or anything like that, to have 80% loan to value. That's interesting.
That's exactly right. Yeah.
And then you would take 35% of the appreciation. Okay, I gotcha. Is there going back? You said there's a 30-year. So again, I'm 48. I plan on being in my house for 20 years. I don't have to pay you guys back at all unless I want to, or unless I sell the house until 20 years, whatever the term is, 30 years. But still, I only want to be in my house for 20 years. I don't have to do anything with Unison until I either sell my house, or if I decide to pay my house to pay off, to give you that money back. I don't have to do anything.
That's exactly right.
Now, you guys, I'm just curious. I mean, you got to have a sales team that knows the mortgage side to talk to homeowners and home buyers, but you also have to have a sales team to raise the funds to do this as well. So, I mean, you got to be well versed in both. I mean, are there? It's got to be a lot of people, investors that are looking for a secondary source other than just typical stocks, bonds, and commodities that see potentially. You can't have. I mean, it's got to be funded pretty heavily, I think, right? I mean, it's got to be a lot of, I don't know a lot, but there's got to be enough people to finance this that it's not going away anytime soon, I guess what I'm trying to say, Brody.
We believe that this will be one of the biggest asset classes on large institutional investors' portfolios in the future. It's bigger than the stock market. It's bigger than the bond market. It's one of the most core assets in the world. And right now it's, I hate to say, but it's very inefficiently invested in.
Right.
You have just a lot of individual risk, like you said, like you mentioned that story of that the real estate market's filled with stories like that, where people have all of their money in one asset, and some people do extremely well, and that might blind us to the fact that some people don't do very horribly and can lose everything. So we really think this is, and this is how our investors are. Come to give it the feedback they're giving us is that this is very interesting. They want more of it, and so we're trying to make this a mainstream asset. And this is why I really appreciate you having me on the call today to just talk about it and get more feedback from you and just get this idea out there.
Anything before we let you go, Brody, that just your experience, you've been with Unison for 3 years, that people ask and I'm missing? I'm kind of looking at my own perspective, but what are some other questions, if anything, that people also say, oh yeah, that I'm not asking about? I mean, anything jump out at you?
Nothing in particular. I feel like you asked all of the really important questions, and some of the common ones, but also some of the less common but critical questions. And I think we really covered this well.
It's not a taxable. Go ahead.
No, please go ahead.
It's not taxable receiving the money, right? Because it's based on return of principal. I mean, that's not a taxable. When you wire the money to my bank, that's not a taxable event, is it? I don't know.
No, I think you tax it. It's you pay the tax once you sell their house at the end. Once once you've sold the house, then you can compute it out of the gain.
Gotcha. Okay, gotcha. Okay, right on. That's fantastic. So what's the? Do you all have a sales staff? And I mean sales staff like they're trying to not like I'm talking about, but just people. If people are more interested in talking more about this, learning more about this, do you all have a YouTube channel? I think you do, but just tell us where we can find more info on Unison, if you would.
Sure. Yeah. If you're interested, check us out at www.unison.com. we also have an Instagram account. I hate to say that. I think I think you can find it. You can find the link for it through the bottom of the website. But check it out. We have a beautiful website that our brand marketing team just finished building, and it has all the information there. Some customer stories. I want to. There's one thing I actually I want to share this with you. Because we're publishing a home affordability report in I think a few weeks from now. So I'll send that over to you. I think you'll find it very interesting. Basically we wanted to ask the question of, if you were saving 5% per year in your income, how long would it take you to afford a down payment in a bunch of different cities? And I think the numbers will surprise you. There's certain places where it'll take you, more than half a lifetime to afford a home. So these are obviously the markets that we're going to be tackling.
No, I mean, it's nuts, man. I mean, think about just like never mind where you're at, but the DC area, Boston. I mean, hell, Portsmouth, New Hampshire. I mean, all these places have just, just regular people can't afford houses in these places anymore because they can't get the financing because the property values are so high. And how do you, I have a VA loan, thankfully, but not everybody has a VA loan, and it's just it's a challenge anymore to be able to secure that piece of the American dream. Which is good as bad, but if you're already in that piece of American dream and it's appreciated significantly, and and again, you don't have the cash flow to finance as much in retirement as, and again, I don't mean hundreds of thousands of dollars here, but I mean $500 a month can go a long way to a guy and a lady who are living off $4,000 a month. You know what I'm saying,
Absolutely.
Brody? So if they can get $30,000 out of there, that's real money, and it's not to be mimicked. It's not, and I think there's an opportunity too. And on top of that, I hate to say no risk because I've been in investments for a long time, but at the end of the day, it's no mortgage outflow, and I think the cash outflow is critical. There is none. So, and I'm not telling people they should go out and do it. I'm just telling people they should look at it for sure, just like they should look at reverse mortgages. I turn away from home equity lines of credit because I just don't think it's nearly as cracked up as people make it seem. But you got a value in your home, man. You got an asset there, and you don't have to be 62, unlike a reverse mortgage. That's good stuff, Brody. I appreciate it, man. And I imagine I'll have some questions, and when I do, I'll email them to you and Cameron, and maybe we'll get you back on here if anything new comes down the pike, new opportunities and new states that you're opening up and stuff. It'd be great to follow this market for sure.
I would love to. I had a great time talking to you, Josh, and please keep in touch. I'll send you that affordability report as soon as it's published as well.
Please do, man. Hey, thanks, bro. Hey, hold on just a second. I'm just gonna hit stop record real quick.